So when you sell this house, you do a 2-year look back, and if you haven't used that gain exclusion, you're good.
Hey guys, Ray and Andrew here, and today we want to talk about selling your primary residence. We get asked this question a lot, what the tax implications are going to be, and people sell homes every day. So Ray, what can you tell us about selling your primary residence?
Right, so when you sell your house, right, sometimes you have gain. So let's figure out what gain is first, right? Let's define that. So, you're going to have your sales price, which you may or may not receive a 1099-S for. Sometimes you don't receive one, sometimes you do. So if you do receive one, it's very important to let us know, because it definitely means that we have to report something on your tax return, because then the government knows you sold something.
Right.
So that sales price gets sometimes reported on a 1099-S. So that's your sales price, and then what you have is your cost basis of the house. So when we talk about cost basis, that's what you originally purchased it for, plus any additions that you may have done, maybe put a deck on or a dock or something like that, that increases the value of the house. So the cost of those improvements, plus any selling expenses, maybe commissions, attorney's fees, things like that, right? So that all goes into the basis of the house. So you take that sales price, you subtract the basis, and that's your gain on the house, okay? So it doesn't really have anything to do with how much debt you owe on the house or anything like that. Sometimes people get confused. And
Paying off debt isn't a tax
deduction. Paying off the
deduction.
debt is not a tax deduction. So once you figure out your gain piece, for married couples, they have the ability to exclude up to $500,000 in home sale gain. If you're a single individual, you can exclude up to $250,000. Now, it depends on whether or not you can meet a couple criteria, whether or not you can exclude that $500,000. The first is that it has to be, you had to have owned and used it as your primary residence 2 out of 5 years, right? Okay. So that's the first test. The second is you can't have done this gain exclusion in the past 2 years, starting with the sale date of your last residence. So when you sell this house, you do a 2-year look back, and if you haven't used that gain exclusion, you're good. So as long as you meet both of those tests, you'll be able to exclude up to $500,000 for a married couple, $250,000 for a single. So now let's say that something happened and you actually had to sell your house a year early after you've already done that gain exclusion. You're like, oh man, now I'm going to have to pay taxes on everything. Well, it depends, right? It depends. So sometimes we can do a partial exclusion of the gain based on your circumstances. So if you had to sell that house early because of, if you had to get a new job, and that new job is more than 50 miles away from your current commute, then you could qualify for an exclusion. Or if your health required you to move, let's say you had a doctor that wrote a note that's saying, hey, for health reasons, you're going to need to move. Or some other unforeseen circumstances, such as like a natural disaster, death in the family, a new baby, a divorce, something that's unexpected or unforeseen that's happened. Sometimes that can qualify you for this partial gain exclusion as well. Now you're probably not going to get the full exclusion, right? But we can get you what's called a pro rata exclusion, where we can get some of that gain excluded. So all is not lost if you didn't meet both those tests, but we definitely need to take a look at it if you do have a home sale gain.
Yeah, no, awesome, good information, Ray. Well, like I said, we get asked that all the time, so I hope that you guys find this video helpful. If you're navigating the home sale rules and the tax implications, if you have any questions, feel free to give us a call.